Wow, what a week we're having. There's been a lot that's come out this week, and I'm going to try my best to get through it all. So let's start on Wednesday. The Fed came out Wednesday, left rates alone. That was expected, no big deal. However, they did say in there that they were going to continue to monitor things with a look towards possibly lowering in September, depending upon what the data continued to show. I think that has been answered resoundingly today. Today, the jobs number that came out was 114,000 versus the 175,000 that was expected. In addition, the unemployment rate went from 4.1 to 4.3%. That's a huge shift, and the unemployment definitely was not expected. So I don't think there's anybody in the world that's wondering whether the Fed's going to lower the rate in September. The question is now starting to be, are they going to lower it by a quarter point or a half a point? And another question that I think we're going to hear soon is, should they have already lowered it based on what we're seeing right now? It's starting to look like we're finally getting back to a point where bad news for the economy is bad news for stocks, but bad news for the economy tends to be good news for mortgage rates. And that's usually how it works. It's kind of like a seesaw. If stocks are doing well, mortgage rates are doing poorly. If mortgage rates are getting better, stocks are doing poorly. And we're seeing that today as there's been a huge sell-off in the stock market. Not that we get excited about seeing our 401ks or anything else get beat up like it did, but it does bode well that mortgage rates are improving. And I think we're going to see more of this coming our way. Now, it's always a delicate balance. We don't want things to get too bad economically. Even if rates are great, that can still not be a great thing for us in general. But there's something called a yield curve. And so there's a 10-year Treasury note, the 2-year Treasury note. So when the 10-year Treasury note is lower than the 2-year Treasury note, that's an inversion because normally the 2-year would be less. Now, what we've been seeing since July of 2022 is that inversion. And there's an expectation that when you see that, typically recessions follow. 9 out of the last 10 times that's happened, we've had a recession. There's a little bit of an asterisk in a side note there. 4 of the last recessions have come when that inversion was corrected. So when the 2-year came back down below the 10-year from a yield standpoint, we had a recession. We are right there right now. Let's talk about another thing. There's something else called the SOM rule. Now, this is long enough. I'm going to give you a link to that. You can learn more about it down below. But that's also a recession indicator. We don't want a deep recession, but we do want to continue to see rates get better, which is likely going to happen as the economy continues to slow down. If we're closing in the next 2 weeks, towards the end of that 2-week period, we're going to continue to watch this. If we've got more time than that, there's a lot more opportunity for rates to get better. We're not touching anything until we have to. So we'll keep you posted. I hope this helps. Hope you have a great afternoon.